Our segment is really awkward. Our customers are too complex for the mass market, but they're too low value for corporate banking, what they call coverage, people in suits. So they get really underserved. So the big banks will try and serve them on a consumer banking platform, and it basically just exposes all the flaws.
Hi everyone, very warm welcome on Aulium. Marcus, it's a pleasure to share the show with you.
To be back.
And really today we can't be more excited because we are joined by Conrad Ford. So Conrad, you are now the Chief Product and Strategy Officer at Allica Bank. So probably one of the coolest banks on the market at the moment. So can't wait to essentially dig into first your personal story and what makes Allica Bank so special today. So really, thank you very much to be with us, Conrad.
Thank you for having me.
And so to kick things off, maybe to go back in time, do you think you could paint us the picture about maybe your early careers and if you always had like a master plan on joining like a C-suite of a bank, or if you had like other things in mind and maybe retracing a bit your sort of journey, which I believe is not necessarily the plain straightforward. I mean, you've been an entrepreneur too, so I mean, yeah, if you could explain a bit like what was the genesis of the Conrad Ford you are today, that would be absolutely amazing.
Yeah, so I was kind of the opposite of having a career plan. And just to sort of bring this to life, my final year of university, I was sharing a studio flat with a friend. He suddenly one day turned up in a suit, right? And this was, middle of sort of hippie student life, right? And I was like, "Have you got a funeral, or what's going on?" He said, "No, I'm going to the milk rounds." So for those that don't know, the milk round, I don't know why it's called the milk round, but in UK universities, it's a tradition. That's the graduate fairs where you then where you go and hear about McKinsey and Goldman Sachs and Accenture. And so he was going to the milk round because he had a very clear career plan. And his career plan was to go into consulting. I didn't really know what that meant at the time. And then he was going to get into VC, which was really early in the UK. And guess what? That's exactly what he's done. And so he followed his plan. He had a plan, he followed it. And he had a plan when he was, 20. So I was kind of the exact opposite. I kind of stumbled out of university, blinking into the light without a plan. I think there's really sort of two things anchored. I thought I need to go and see the world. In other words, I'm not going to jump straight into because a lot of my friends who rolled out of university without a plan ended up working in the big accounting firms, which, by the way, I think is a great start, a really good start. But no, I wanted to go and see the world. And I always kind of assumed I would dent the universe in some shape or form. I just didn't know how. So I stumbled out. I spent actually my first permanent job, believe it or not, was when I was 26 or 27, and I'd left the university in 21 when I was 21. So I kind of stumbled around, did some temporary jobs. This was the time of the millennium bug. So for the youngsters amongst you won't know this, but we were all told at the end of the last century, or the end of the last millennium actually, that the world was going to end because computers weren't able to deal with the date change.
Oh yeah.
Yes, it sounds crazy, but there was over £500 billion was spent on fixing this problem. Planes were going to fall out of the sky, and nuclear power stations were going to explode. So there was tons of contract work there for anyone remotely intelligent. So everybody who could actually code was fixing the millennium bug, as it was called. So anyone who was remotely intelligent like me was doing macros for Excel and building Access databases, which at the time, the whole world was held together with Excel and Access back then. So yeah, I did contract jobs, I saw the world, and then I got sat down by a fierce auntie when I was about 25, and she told me, "You need to get a qualification, you're wasting your life." So I took the message and I went into investment banking. And so I joined one of the big investment banks. Not doing a very interesting role, by the way, but obviously investment banks pay well, but it was not the massively interesting role. But I qualified as an accountant whilst I was there. So I remained a qualified accountant, although I don't do much accountancy these days. And I think the first proper job I got, and what I mean by that is one where I was actually felt I was doing something that perhaps I was, the right thing to do, was I began to think that strategy sounded interesting, and I got a job with strategy in my title at the investment bank. I wasn't actually doing that much strategy, but I got it in the title, and I got headhunted at the peak of the dot-com boom. I got headhunted into Barclays Bank, into the corporate strategy team, and then suddenly I found myself doing a role thinking, you know what, I'm not bad at this. So yeah, I spent a few years in corporate strategy, working alongside most of my colleagues were kind of ex-McKinsey and ex-Bain, but I wasn't, but I understood investment banking, which was valued in the team. So yeah, I spent a few years in corporate strategy, and actually, fun fact, that's where I met my boss, our CEO. He and I go back pretty much 20 years when we met working in corporate strategy a long time ago at Barclays Bank. So yeah, that was the first time I kind of felt I actually had a career. I was thinking, actually, I'm quite good at this. This is an interesting job. I feel I'm actually doing some meaningful stuff. And then I decided it was time to get out of strategy for no reason other than the fact I think strategy's got, as a career, has a shelf life. So in other words, it's a great accelerator of your career, but very few people survive the whole career doing strategy. So not because I disliked it, but I just kind of thought my tour of duty is over. So I found a very small part of Barclays, small subsidiary of Barclays that where I could actually get a big title because it was very small. And I thought I'll go and do that job. It was chief operating officer of a small subsidiary, and then I'll go and get a big C-suite job in a bigger part of the bank. Yeah, that was my plan. The subsidiary had a lot of freedom. We were in a branch above. Sorry, we're above a bank branch in Shoreditch. This was when Shoreditch was just at the very start of the tech revolution. There was a few tech firms there, but we had a high degree of autonomy by banking standards because we weren't doing anything particularly risky. And I kind of got a taste of freedom, and that was it. I wasn't going to go back into the big bank. And after that, I decided to found a company, and I founded a startup, which was now must be 10, 15 years ago. I founded one of London's earlier FinTech businesses. And going right back to the start of the arc, I said that I always kind of assumed I'd done the universe. At the heart of that really was that I was kind of like, by this point, I think I must have been second half of my 30s, so late 30s. And I was thinking, well, I never set out to be a corporate person, so I want to actually go and see what I can do. So I think it was really a midlife crisis that led me into startup world, but it certainly wasn't a plan I had when I was young. So yes, hopefully that's a good summary.
Yeah, no, very good summary. Thank you. I mean, maybe a couple of follow-up questions on what you just said. So what do you think, like very few people essentially survive in the strategy function? I mean, do you think because it lacks a bit of, sort of hands-on experience on building products, maybe creating teams, or is there anything specific?
No, I don't think so. I think there's two dynamics that are quite specific to it. Firstly, the consultancies is very much up and out. So in other words, you're expected to make it to the next rung of the ladder in a certain time frame, and if you don't, then it's up and out. That if you're within the pure consultancy world, certainly the bigger consultancies, you kind of like eventually you miss your ladder, your rung, and you're gone. Then you typically would go in-house, like the corporate strategy team that I was in. But the second one is, it's just very hard work. It was regular for me in those days to be working midnight, sometimes on projects. And actually, I'd say the element of being sort of operator versus strategy, the actual thing that actually began to frustrate me was not the work itself. It's the fact that you could work till midnight for 2 months on a project and then suddenly get a random email saying, it's been discussed, we're closing down this project. So, you put your heart and soul into what, in the end, you're kind of thinking, well, all I did was produce some PowerPoint slides. But it's extremely hard work. I remember I was working on it. We had a team helping us from one of the big consultancies. I won't say one of the big four prestigious consultancies. And there was this, I was working till about midnight, and I decided to go home while the tube was still running. And I realized the partner from this firm had fallen asleep at his desk. So I kind of tapped him on the shoulder and I said, look, time to go home, it's midnight. And he literally looked around and just started working again. So yeah, and I thought, and I think, he, from memory, I mean, he was certainly approaching middle age, and I know he had family from memory. So, I just don't think it fits that lifestyle. I think many people leave the consultancies and go in-house to where things aren't quite as intense, and then when they go in-house, they're looking to kind of make the move out of strategy, and I think it's a very reasonable thing to do. I think I wouldn't want to spend my life writing PowerPoint, however much I was paid. in the end, you learn some very useful skills, but in the end, PowerPoint is not one of them.
Yeah, that's really interesting. It sounds like you enjoyed the strategy aspect of the
I did.
work, and the work was very rewarding. But then I guess the intensity is sometimes also, and maybe it's also the environment and the structure. Was it anything about the corporate structure itself that you benefited
Not
from, or
really. I mean,
you really enjoyed?
that team actually had a really good culture. It was very collegiate. In other words, people weren't kind of, sharp elbows trying to climb that, there's always one or two. But I remember a couple of people coming across from peer teams in similar banks and actually saying it's such a better culture here because people are trying to build something good together. All big corporates have pockets of terrible behavior and pockets of excellent behavior. The really good ones have much higher pockets of good behavior, but I just happened to have landed in a genuinely good team with a good culture. It was supportive. There's only like one time maybe I felt I'd been thrown under the bus by somebody senior, and that's pretty low in 4 years. So yeah, it was a good culture, and I also value that aspect as well. I think culture is so important. In fact, I've come to conclude it's pretty much everything.
Mm-hmm.
The kind of culture eats strategy for breakfast. I happily say that and endorse that as the chief strategy officer. Yeah. We could overcome a poor strategy, and we couldn't overcome a poor culture.
And so, and so coming back to the inception of your funding options, so the startup you funded on your own, which is quite, I don't know if it's unusual, but you hear more about teams like starting businesses, etc. And how was it? I mean, at the beginning, why did you decide to do that alone? Looking back, do you think it was something advantageous for you, or do you think maybe you would have gone faster, or maybe you would have avoided some mistakes if you had like someone else with you? What is your assessment today of that sort of experience?
Yeah. So firstly, it's horrible being a sole founder. I'll just say it bluntly, right? All the weight is on your shoulders, and believe you me, that really weighs on you, right? When things are going badly, by the time I left, we had like 80 people. And occasionally you'd walk into the office and just suddenly realize all this exists because of me, this amazing culture and buzz and office and amazing people. Literally, it only exists because of me, right? In other words, there was only me back when it was me in my bedroom. But more often, far more often, it's you thinking, I've got to pay these people in 2 weeks' time. We haven't got any money. and I'm going to have to walk out and tell them. And every single one of them didn't join funding options. They joined me. It is my responsibility. And the investors are my responsibility. So it is a horrendous weight on your shoulders. I get asked this question a lot by people founding. I say, and I believe this, I genuinely believe this to be true, by the way, the only thing worse than being a sole founder is founding with the wrong co-founder. So in other words, it is worse to have the wrong co-founder.
Mm-hmm.
I mean, a very high rate, the number of failures of startup companies come down to found teams. And I'll just sort of bring that to life with a kind of real world example, which is quite common. You think you're founding with somebody who has your drive and ambition and work ethic. But it turns out that they leave the office at 6 o'clock and you're working till 11 o'clock every evening. For a week, you just kind of turn a blind eye and you're building together. But if it's happening months in, months out, and you've got 50% each share of the company, then eventually just things snap, right? And it's like a bad marriage. They're going to snap badly. And you can bring down a perfectly good company. There is data on the most successful founding teams. The most successful founding teams have worked together. Second most successful or source of successful companies is went to university together. And I think the interesting dynamic there is it shows that both scenarios, you've been alongside somebody and seen what they're actually doing when they're doing their work. So in other words, that kind of mismatch in terms of drive, ambition, etc., I think can be fatal. So my genuine opinion is the only thing worse than a sole founder is the wrong co-founder. But I don't think I'd ever be a sole founder again of the business I was trying to make big. I'd happily build a lifestyle business as a sole founder, but I wouldn't try and build a big one.
Yeah, so essentially what you're saying, it's better to be single than married to the wrong person.
Yeah, but it's better to be married to the right person than neither. That is exactly what I'm saying. Yeah.
So why do you think, like, I mean, a bit of a sad question, but why, VCs and investors are, like pushing a lot, for teams, etc., rather than maybe identifying like one great person with one great project and then trying to find someone else along the way. So let's say more like a late co-founder type rather than have the team straight on. Because from what you say, essentially, well, it's not necessarily the best option to have two person or three
Yeah,
persons.
I mean, I would say if I went again as a sole founder, for a whole variety of reasons, I think the mental toll would be much, much lower. Firstly, I've got an element of being proven, which means that the money would flow to me. I think venture capital or angel investment is a bit like kind of enterprise sales, where the art is turning into inbound sales, where you're basically plucking through leads of people who've already read your white papers and attended your webinars. The truly great companies, of course, they have VCs queuing up. And it's basically saying, actually, might raise early next year, but nice to meet you, but not interested. The obviously great companies have investors queuing up. Now, because of my track record, I would imagine that I know it would be a lot easier to raise money. And by the way, raising money, I'm sure we'll talk about VCs in a minute. I'm not a massive fan of the average VC. I like some of them, but it's horrendous. And one of the worst things about it is that you start this process that you think is going to be 3 months and is inevitably at least 6 months. And the business plan you've written at the start of that 3 months would have happened if you hadn't been in fundraising mode. But guess what? The business you come back to has just drifted in your absence, particularly if you're a sole founder, as I was. It's just incredibly time consuming, emotionally draining, and many, many other things, right? And massively distracting from the actual action of building a business. I think all the great leaps forward that Fund the Options made were just after fundraise, because you could basically think, look, I've got 18 months runway. I can extend it to 24 if necessary. You spend 6 months doing the things that you actually needed to do, rather than chasing some metric because it will help the investment. Vanity metrics are useful for raising money, but they're not useful for building a sustainable business. All the great leaps forward were in those sort of 6 to 9 month periods after we raised money, and we could actually really focus on building the business.
Yeah, just one follow-up question, because it's such an important point, the co-founder point. In your view, with all the experience that you have now, what would you say makes the perfect co-founder match? Like, what would you look for? Is it one has more of a generalist experience, whereas the other one's more specialist, or one is more salesy, one is more technical? Is there anything in particular that you would suggest is the best way to go for it?
I would say both of those examples and more examples are really variants of the same thing, which is that there's somebody who goes out and spends time in the outside world, and there's somebody who spends their time inside building the business. And whether it's building the technology of your product-led organization, or it can be a COO type figure. I guess it can, and that person facing the external world, they can be the figurehead doing PR and government lobbying, depending on your business, or they can be the enterprise sales lead, or whatever it may be, right? But I think that kind of mix of inside and outside is the characteristic. A founder that I kind of grew up alongside is the co-founder of iWalker, which is a great SME lending business. Our businesses kind of grew up together because we were partnering rather than big competitors. He has a co-founder, but amazing co-founder, by the way, but you don't see a huge amount of that person, right? And I think, I talked about the distraction of fundraising. Well, guess what? There's so many things that distract you in the external world, not just fundraising. Enterprise sales is incredibly painful and time consuming. So I think a mix of inside and outside, but it depends on the nature of the business. If you're a heavily tech and product led business, then it's really a CTO is that inside person, but it doesn't have to be. Many great businesses are about execution of sales engines, and that is as much an internal activity as external. That'll be my observation. But the thing that has to be true is you have a very high alignment of what you want to achieve together. If one of you wants to build a 5 million company and one who wants to build a 500 million pound company, it's not going to work if you're 50-50. Yeah. Because to build the 500 million is going to take just gargantuan effort and drive, and it's going to consume a life.
And do you think founders just more generally need to be of more of a specialist or more generalist, so broader experience? I mean, there's kind of different school of thoughts here, but what's your view?
Well, I mean, I speak to a lot of early stage founders, particularly when I had time off between companies. I think I have begun to see the world through the eyes of a VC when I talk to early stage founders, and I kind of say, look, my experience is a VC will think in these terms, and for the avoidance of doubt, these are the right terms. So in other words, if these things are not true, you're going to fail, right? So it must be a big market. Most people who come from a corporate background or strategy background, they fully understand how to size the market. Very often I find they miss point two, which is it must be a broken market. Yeah. So there's no point entering a big market that's pretty well served by the incumbents. So in other words, you've got reasonably high NPS and blah, 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 blah. So what's your opportunity? Unless there's a big blue ocean pool of low value customers or something that people left on the table. But if it's not a broken market, why would someone switch from an incumbent they're reasonably happy with to you that's twice as good when you need to 10x? So is it broken? And then there's also the why now. So has something technically changed? Has something regulatory changed? If you haven't got a good answer for why now, then the question has to be asked, well, why hasn't someone already executed on this? And then the final one is why you, which is my answer to your question. Very often it's about, you must have a deep understanding of that problem. So payments in FinTech is a good example, right? Payments is incredibly complicated. I still don't quite understand it, right? What it takes when I tap my card in a shop.
That's very honest.
Well, there's many beaks to feed along the way, and I wonder what value most of those beaks are feeding. Guys, I've become a bit of a stablecoin junkie on this basis, actually. But my point is basically, you get some amazing payments founders who basically sat there frustrated for 10 years in one of the big incumbents, just thinking this could be so much easier, so much better. Payments has created, decacoin after decacoin. So there must be a why you reason. And I think too many startups, for example, are focused on solutions for other startups. Well, guess what? That's because you've lived in a bubble. Yeah. Live in a big real market and then figure out what's wrong with it. And by the way, I follow that through even to my hiring practices. What I love is finding people who are, restless and a bit frustrated with working in one of the incumbents because they have the knowledge, but they have a different set of values and culture to the incumbents, which tends to kind of, attract the journey people, journey people. But you don't want them to be too frustrated, but you want that kind of restless energy that they're just sitting there thinking, we could be so much better. Yeah. Well, bring them to us and they can make us so much better. That's what I look for.
And so for you, so I mean, you've seen the industry from different angles, like you've seen different environments as well. I mean, corporate, non-corporate, startup, growing, struggling, etc. I mean, do you see like a clear difference between you and other members of executive committees, boards, etc. you sit with today? I mean, do you see that you've developed like a very specific way of looking at things, which is not necessarily shared by other people who manage to go up the ladder, but in a more corporate setup? I mean, do you see like?
Yeah, I mean, I'd say I do feel that's my kind of superpower. I literally went from a head office with 5,000 people in an enormous tower to me in my bedroom, right? So, and honestly, I genuinely believe this, by the way. If I went back into one of those big towers in the big banks, the big HQ towers in Canary Wharf, I could spend a month there, just wander around, and then give a list of 2/3 of the people that I can get rid of, and there'll be no impact on the business. It's a bit like the Matrix. You can just you become Neo. You can see basically these jobs are adding no value. These jobs are supporting other jobs. You can get rid of them both. What are you working on? PowerPoint, gone. Yeah. What have you got a meeting about? What's about? Gone. Yeah. There's just so many people doing none jobs and hiding basically. I have that superpower. Yeah. Which is basically really, really first principles. I don't know if you've read anything about Elon Musk's thinking, but there's a brilliant biography of Elon Musk. I think it's an authorized one by Walter something or other. I read fairly recently. Elon Musk has an expression of moron tax. Yeah. So basically, this is particularly around his building spaceships, by the way. He looks at the cost of raw materials and then looks at the cost of the thing he's buying, the item he's buying. And the difference in the raw materials and the cost of buying is moron tax. Yeah. So for example, and basically he just is eliminate. So for example, on the SpaceX rocket, there's really expensive components to move the fins. Yeah. He figured out you can use the things that closes the Tesla door with a tiny fraction of the cost. It has the same capability. Rockets, he figured out to get to Mars, to land on Mars and colonize Mars, you need rockets for $200,000. when they were $2 million. So he basically found the 80% or 90%, sorry, more on tax, by simplifying, decomplexing, etc. So I kind of, that superpower I do have, and I think it's very hard to see that if you've been certainly life in corporate. I think the other thing is tolerance of uncertainty. I remember early in my career in my current shop, we had a product launch where we weren't hitting the numbers in the first few months. And I remember sitting there in absolute astonishment, realizing in the meeting, I seemed to be the only person in the room who'd fully expected we wouldn't hit some numbers that had been written on a spreadsheet by somebody who was no longer in the business 2 years ago. The only thing, pre-launch, the only thing you know with absolute certainty is your business plan is wrong. Guarantee it, right? So that kind of like that tolerance for uncertainty. In other words, all that matters, we've launched now, we're in front of customers and we're learning, we learn quickly, Everyone calm down. We calm down, we build from here, But we've got over the first hurdle, we've got real customers. We just don't have as many as we think we did, and that business is doing amazingly now, by the way. But that's my point. I think there's a rigidity around corporate thinking, and I think it's fundamentally held up by the fact that everyone has a shared interest in not calling out the nonsense. I was about to say a word, read a word beginning with B, right? Because basically their career, so they're paying for their house, feeding their families, basically is basically building these nun jobs. And of course, the people who are ambitious, they build their status by being involved in as many decisions as possible. In other words, maximizing their veto power and maximizing their empires. And that is a guaranteed way to bring a business to a halt.
And so coming back on what you just said, so you have a business plan. The only thing you are sure about the business plan is that it's not going to happen. Do you think you could tell us a bit, what was the story around funding options? From the moment where you set it up, like the initial concept, to the moment where you essentially exited the business and eventually sold it to Tide, or essentially like a super successful and happy event, something like any entrepreneurs would or should wish for, like an exit moment. Do you think you could essentially quickly tell us how you started, what was the initial concept, and where did it end?
The initial concept point is super interesting because the business that eventually succeeded was highly aligned to the initial concept. But there were so many tangential cul-de-sacs I wandered off along the way. But in the end, the original vision was right for various reasons. There were so many cul-de-sacs we went down, but the original vision pretty much paid off. But first and foremost, I was a pretty terrible founder in the early days, 18 months, 2 years. And that was for one simple reason. I'd come out of corporate, basically, and basically kind of thought I knew it all. And I'd come from a strategy background, which meant basically, the best way to figure out what to do is to do some strategy work, right? Let's get the data, let's figure it out, let's do desktop research. I hadn't read the Lean Startup book, right? I imagine some people had told me to read it, but I'm actually a bit more forgiving of myself about this point the more I thought about it, because it's actually quite hard to imagine this because of how quickly the startup world has emerged in the last 10, 15 years. But actually back then, the stuff that's really obvious these days, because people are inculcated in the incubators and accelerators and the mentorship programs, it was actually pretty immature then. I mean, back then, when I was founding Funding Options, I think London had probably only produced at that point 2 digital unicorns, something I'm aware of. One was Betfair, and the second one was Wonga. Now, there were some really strong people that had come out of that with reasonable, decent money and were doing angel checks. And perhaps they could have mentored me and helped me. But fundamentally, there wasn't the amazing ecosystem that there is these days in London. London is very, very, has huge depth in that, not compared to Silicon Valley, but compared to, I think, anywhere else on the planet. I think if I'd founded Funding Options 5 years later, I would have had half a dozen very authoritative people saying, Conrad, stop doing what you're doing, read the Lean Startup book, which, by the way, is very often a guidance that I have to give to startup founders these days. But I basically approached it from a corporate direction, didn't get my first live customers until month 9 or something. And I literally could have had live customers on day 1. I could have been revenue generating in less than a month, let alone live customers. The reason is because the business I was doing was largely unregulated. So in other words, if I ignored some niche fringes, it was unregulated. I could have stuck up a website and basically been the person doing what Funding Options does, which is intermediate SME finance And then I could have built a platform and solution, a proposition and scalable engine around what I learned, but I didn't do it that way around. I built the platform first. I should have followed the lean startup. I didn't even need the lean startup. It's a blunt answer. I had a bit of luck. I'd say luck and lack of luck, or bad luck, basically fairly balanced over my time at Funding Options. But I probably had disproportionate bad luck in the early days and disproportionate good luck in the later days. But the piece of good luck I had is, I think when I was probably, 2 years in maybe, I really hadn't achieved much with the angel investment I'd had because of what I just said. But luckily that was kind of the coming up to the peak of alt-fi. So the kind of first wave of FinTech was alt-fi. It was all about digital lending. That bubble popped a long time ago, but this was approaching the peak of that bubble. So although I hadn't made huge progress with the business, I raised 2 million quid, which back then was a pretty big round, by the way. Rounds have got massively bigger in recent years. So for the business at the scale I was at the time, we were always lean. I've never been someone who wasted money. For the business we had at scale, that was a lot of runway, a lot of capacity. And that basically, that I happened to be raising towards the peak of the alt-fi boom, allowed me to raise enough capital, because the irony was, although I'd taken too long to get the product market fit, I had it. I just had some fairly unhappy investors. So I knew that I knew what to do at that point in time, and luckily timing meant that I managed to raise a decent check. I think if it had been 18 months earlier, I would have only been able to raise $1 million, and that wouldn't have been quite the breathing space that I needed. So yeah, there was a bit of luck there. And then basically that was the inception of what was a period of genuinely exponential growth year on year. So exponential is an overused term, but we grew 3 times in a year and then twice, doubled again the next year and then doubled again. So we don't have the proper hockey stick, and that's revenue, by the way, not some vanity metric. You kind of built that scalable, repeatable engine. I made a really key hire. I brought in a chief commercial officer who actually came from a recruitment background. So not an obvious hire, albeit they've been recruiting into FinTech. So they understood conceptually FinTech. But what he gave me was the playbook of how you build a scalable acquisition engine, the kind of, the SDRs, the account representatives, the kind of the B2B engine. I was already quite good at CRM, by the way. I understood CRM well, but what I didn't understand was how you build that scalable Salesforce type acquisition engine in B2B. And he brought that in, as well as some great leadership skills as well on the commercial side. So, things came together, and then we had that magical period where, product market fit. Very often people ask me if they got product market fit, and I was like, well, you wouldn't be asking me if you did. So yeah, I felt it maybe 3 times in my career now. And believe in me, right? Because you're no longer pushing the rock up the hill, right? Kind of like thinking, oh, this is getting quicker. I must be on the other side of the hill now.
Yeah, absolutely. And then just to the final stage of that. So how about the acquisition by Tide? So how did that come together? And would you mind talking a little bit about that?
I mean, first and foremost, I wasn't actually around at that point. So I left the business in 2019. So this was, if you want to cast your mind back to when this was, it was autumn 2019. That was when we were reading these little tiny articles in the newspaper about this bat disease from China. Yeah. It was literally 6 months before suddenly everyone was like, oh my God, what is this? Completely coincidentally, I left about 6 months before COVID. Left on pretty good terms. I just didn't have anything left in the tank, to be honest. It was time for me to go. I knew that. My investors and board knew that. I was kind of done. So I left in autumn 2019. CEO, who'd been my chief commercial officer, took over as CEO. And actually then he had to take the business through COVID. So obviously nobody knew at this time, but that's what he had to do 6 months later. And it wrecked the business, right, to be clear. So Funding Options is not a recurring revenue business. So revenues pretty much went to zero in that first lockdown quarter, the first quarter, also second quarter of 2020. So he effectively had to rebuild the business. It's now twice the size of in my time and very profitable, by the way. I still follow the accounts. So they've done a brilliant job, that team, that took over from me. Long story short, it sold to Tide after I left, but it made sense as a home to me. Because I work in another SME focused FinTech bank, I recused myself. I said to the investors, look, now I know who the potential acquirer is. I don't want to be involved. I don't want to taint the transaction. So I was kind of like just out of the blue, I just got some docs to sign, basically. So I wasn't really involved in the transaction because I thought it would potentially jeopardize it. And I feel a lot of stewardship. I'm very proud of Funding Options. So I didn't want to get in the way. But I can see the rationale. I mean, just if you want my opinion, this is not an official version Tide is not a
Mhm.
bank. It doesn't have a bank license. So it's hard for a non-bank to make serious money in lending. Therefore, they must have concluded that a aggregator was a better way to monetize lending rather than balance sheet lending because they don't have a balance sheet. I think that was probably the rationale, but that's my speculation rather than knowledge.
Okay, so maybe just before we dive into Allica Bank and the sector, for the banking sector, do you think you could just explain to us what was so magical about your go-to-market B2B, sales prospection engine, just so we can, learn a bit more, like if we want to get tons of, partners and sponsorship for Aulium, I mean, what do we need to put in place?
Yeah, I mean, firstly, if you're trying to get sponsorship, then you're doing enterprise sales. You're doing traditional B2B. So no, I make that caveat because so I think there's probably 2 or 3 things where I would happily claim, still being British and humble and modest and all those things. I'm probably in a very, very small elite group in this country and perhaps in Europe. One of them is direct acquisition of SME customers. So if you go to a marketing agency and say, hey, can you give us a marketing playbook or do a marketing? They will basically say, well, you're doing businesses, that's B2B. Yeah. They have this very binary classification, B2C and B2B. So what is B2C? It's mass market. It's adverts on Britain's Got Talent with a flashy brand, right? It's about throwing enough mud and hoping it sticks. So you put an advert on Britain's Got Talent, 10 million people watch the advert, 1 million of them will be target customers, like that'll do, right? B2B, in the minds of a conventional marketer, is enterprise sales, right? It's about getting someone to attend webinars and download white papers and getting them past a gateway where they share their email. And it's about stakeholder mapping and the 20 or 30 decision makers in the firm you're targeting. Yeah. It's about these long, complex sales cycles. There is a middle ground, and I call it B2SME, beta-SME. And very few people understand the playbook of how to do it. Because generally speaking, an agency will, let's get them to attend some webinars and download some white papers because they're businesses, right? If you've actually spent time working with SMEs, as I have now 3 times in my career, they are extremely busy people, and they're not people who read white papers. They really don't have time for the important but not urgent. So you have to have a different marketing playbook, and it sits somewhere between the 2 extremes. Yeah. So in other words, there's 3 types of marketing, not 2. Is the point I'm making. Now, I said with consumer, you throw enough mud and it sticks, right? Part of the reason for that is because here in Europe, it is illegal for me to know lots of information about you unless you give your permission. Yeah. So I can't go and look at your credit report and figure out who's lent you money and stuff, right? I can't do any of those things because of our data protection legislation, which I'm very glad we have, by the way. And there's also limits on telephone. You can't phone someone who's signed up for what's called the telephone preference service, right? So you have to go mass market. You have to go sloppy and wide because you can't go narrow. So there are many reasons that SME is hard, and most people fail at SME acquisition. Yeah, that's just a simple fact. It's an absolute graveyard of acquisition, particularly the valuable larger SMEs, right? So if you want to go after the really tiny businesses, you can hit them when they're opening up their business, but most of them won't survive the year. So it's the point, right? So yeah, there is tons of publicly available information about these medium-sized SMEs. There's tons of it. There's companies' house filings, registry filings. There's what's on the websites. There's information about their export and import. There's public information. Government contracts they have is public information. There's tons of public information. There's providers that aggregate that information together. Yeah, you can build a mass targeting engine. Yeah. So in other words, I can't know anything about you as an individual for data protection, but it's not the same with a company, not an incorporated company. In fact, I can email your core company address. I couldn't email your personal Gmail without permission, or I shouldn't, but I can email your company address as long as it's easy for you to unsubscribe. Yeah. So you build a mass targeting engine. So our target segment in the UK of the large SMEs is our segment. There's somewhere between 500,000 and 1 million in the UK. So my expertise is how you build that mass targeting engine, and there's not that many people have figured it out. It's one of the. I'm kind of claiming the efforts of other people, but the kind of thesis of how you do it.
Did you patent?
No, I'm not sure. In America, you can probably patent it. You can't patent it here. So yeah, it's that kind of that mass targeting. And you take some of the elements of enterprise sales, not the kind of stakeholder mapping, because basically you're selling to one person or perhaps two if there's a finance manager. You don't do any of that, or a co-founder of the business. You don't do any of the kind of stakeholder complex sales. What you do is something, kind of like we can hit this individual through multiple ways, through letters and follow them on LinkedIn. In other words, basically you kind of create this tunnel of valued content around that individual and relevance around that individual. But let's talk through a worked example of what's entirely possible. I could send a letter to a business that's just landed a contract that inevitably means they're going to need to buy a government contract. That means they'll need some more trucks. I can imply that from publicly available information, and I can hit them right time, right product. That's how you win. So to answer your question, what you need to do in terms of getting sponsorship, you're probably more like an enterprise sale. But yeah, we built a really good engine at Funding Options. Well, not me, my amazing colleagues have built an amazing engine here at Allica. But the other side, the once the customer expresses an interest, is around having these teams of sort of early stage career people, maybe calling up cold leads, and just basically occasionally they'll activate something and hand it over to a grown up. But fundamentally just learning how to talk about it, how to talk to customers. And then they graduate into the team that kind of does first contact with relatively lower value customers. Then you get very good at triage. So the higher value customers go straight to one of the very best people and the phone's instantly picked up. It's around building a really scalable CRM type engine. Is how you do it. You probably can't do that for podcasts, by the way.
Super helpful. I mean, it will give us a lot of material to digest and think about. So if you do receive like a letter from us, you'll know why. Maybe so about Allica Bank. So do you think you could essentially explain to us what Allica Bank is? I mean, it's a bank, obviously, but you specialize on SMEs in the UK. Could you explain to us like what Allica Bank is, and maybe put in context like what the markets looks like for? So I'm an SME. I mean, what sort of options do I have in front of me? What is Allica Bank in that mix, and what makes it very much different?
Yeah. So firstly, we are a UK bank. Bank is a misused term these days in fintech land, but we are a regulated bank by the UK PRA, which, by the way, it's extremely hard to get a PRA license. That's a competitive moat in itself. So yeah, we're laser focused on a segment. It's not just SME. This is crucial. There are, using the UK example, but you kind of find these proportions would be reflected in pretty much any Western economy. In the UK, there's, using round number, there's 5 million SMEs, but 90% of them are micro businesses. They are tiny businesses. They are a single person plumber with a van. They're a freelance contractor. They're a freelance hairdresser. The vast majority of businesses numerically are micro businesses. Although they're very numerous, they're actually a very small part of the economy. So although they're 90% of SME, they're only about 10% of the economy. There's an elite, versus commas, kind of like 10 to 15% of the SME population. Internally, we call them established SMEs, and they represent, although there's a smaller number of them, a few hundred thousand, they are a third of the economy. Okay. So there is a, Pareto or 80-20 doesn't do it justice. There is a power law in the SME segment. By the way, there's a power law further up the curve. Like you've got a small number of very large corporates are half the economy. So there is there's an extreme power law in business demographics, right? And you'll find that in almost every Western economy. So the vast majority of turnover of SMEs is in a small 10 to 15% pot of the SME population. In financial services revenues, it's even more acute. And that's because the microbusiness segment has very little borrowing capacity and very little in free cash. So in other words, there's very few ways you can actually monetize those customers. For example, if you offer them cards, as many fintechs do, right, you're going to get some interchange on a few £1,000s a year. It's a very, very small revenue pool. So yeah, we're very focused on a segment of SME, which numerically is only 10 to 15% of SMEs, but it is the vast majority of the revenue pool. So why we focus on that segment, other than that we do genuinely love them, by the way. Having been a business owner, I feel an affiliation with business owners. And, having been the person waking up at 3 a.m, worrying about payroll, I really do care about that because I've been there. So yeah, why that segment from a strategic perspective? the big banks, what we call universal banks in our industry, find it a massively challenging segment. And there's an underlying structural reason for that. They have two major revenue centers. One is a mass market one, which is predominantly consumers. So in the UK, 30 million households. It is also the 5 million micro businesses. And the reason for that is because those micro businesses are so simple in their finance needs and circumstances, you can serve them on the same operating model and platform. So for example, one of the big banks was offboarding all their SME customers with more than 2 directors. And reading between the lines, it's because their consumer current account supports 2 payees, spouse and a spouse. Yeah. So their operating model for the SME segment is designed for consumers fundamentally. But the micro businesses are so consumer-like, they get a pretty good service from the big banks because they're so much like consumers. The dominant form of finance for micro business is a personal credit card. 1/3 of them use a personal credit card to fund their business. If you think about it, it makes perfect sense. You're a tiny newsagent. You're buying a few £1,000s of stock. You're going to a cash and carry. Why would you do a loan application at the bank? You just need a personal credit card. Yeah. So yeah, micro business is actually very well served by big banks as its consumer. Right? Despite the kind of customer growth of consumer fintech neobanks, the reality is the vast majority of the revenue pool of consumer is still with the big banks, right? So the big banks are still winning if you're looking at the metrics that matter, and it's the same with micro business. Okay, that's micro business. So that's mass market. It's all about digitally first, simple, homogeneous customers. The other extreme, of course, is corporates. So they're very large companies. So the big banks do what they call coverage, which is throw lots of high quality people in suits. And believe you me, they're high quality people. You're not going to land a punch on the big banks in the corporate segment. Nobody has, and I don't think anyone will. Our segment is really awkward. Our customers are too complex for the mass market, but they're too low value for corporate banking, what they call coverage, for people in suits. So they get really underserved. So the big banks will try and serve them on a consumer banking platform, and it basically just exposes all the flaws. So you end up with 10, 20 years ago, the customer would have had a relationship manager in the branch who would have papered over the cracks. But they've taken away the branch and the relationship managers and now exposed the cracks. And the customer, the NPS from mid-sized businesses about their banking have just collapsed. So we've gone after this third of the economy, deeply unhappy customers. And it's because of that strategic focus. For those that don't know, we're the fastest growing fintech ever the UK has produced in revenue terms. So we've beaten the high water mark of some very, very large names in fintech because we are focused.
I was going to ask if you could give us some numbers. I think I saw like a LinkedIn post, from Allica Bank, like saying that you contributed something like 6 billion to the UK GDP or something like this.
Yes, that's the impact of our lending, to be clear. So our lending is to SMEs, and those SMEs, grow with our lending. So and my favourite of those stats, that was a research paper by Oxford Economics, a well-known research consultancy. So more than at the end of 2024, so we've moved on a lot since then. More than 80,000 jobs have been supported by our lending. So that's the kind of indirect impact of Allica. But yeah, I mean, we are coming to the end of our financial year. We just finished our financial year. So I don't want to give any financials because I have to data. I'm not allowed to tell you. But what is in the public domain is our lending balance sheet is kind of in the £3 to £4 billion range. So it's quite substantial. We are officially the fastest growing fintech the UK has produced in revenue terms. We were named the fastest growing UK company of the century, actually, by Deloitte in 2023. And after our sort of first 4 years of growth. So we've been very successful on the revenue side. But we are profitable as well, by the way. We've been profitable from a very early age. Albeit for banks, that's pretty easy, by the way.
But just on that point of of the fastest growing company in the UK, I think it's quite an impressive stat, and congratulations on that. Could you describe, so what does that actually feel like on the inside when you're growing that fast?
I would say we kind of locked in scaling pretty early. It was the really early days of that were the hard ones when you hadn't once you've locked in the kind of repeatable, scalable, then you begin to attract capital and lots of capital. In other words, you could probably you could take more capital than you choose to take. At which point you can just invest in doing it properly. We also have our CEO, Richard, my boss. He was number 2 at Revolut for a couple of years, so he's seen what fast really looks like. Right? So the kind of playbook of how you scale. I would say that we obsess about 2 things in particular. One is organizational design. So basically, there's a very small number of companies in the world that have mastered scaling quickly at real scale without slowing down. I'd say Amazon's probably the most prominent example. And they've mastered that through organizational design, reducing dependencies, bottlenecks, empowering teams, cross-functional teams. The famous one that everyone seems to know about is the two-pizza team. But if you read a book about Amazon, there's an amazing book called Working Backwards about Amazon's ways of working. There's so many things they learn along the way, and they're just brilliant. Brilliant. Revolut's clearly another that's managed the art of, how do you scale in dozens of geographies and dozens of products, right? How hard is that? That is infinitely hard, but they somehow make it look easy. So organizational design, and the other side of that, really, they're two sides of the same coin, is culture. We absolutely obsess about culture. And I'd like to think that culture is probably the area of the two, the one where I've kind of got the most hard expertise between the two, because I've kind of been through this journey. This is actually the third time I've been involved in one of Europe's fastest growing companies. Of course, one of them was a business I founded as a sole founder.
The magic touch.
Well, I don't know, who knows? But what I did learn, particularly building funding options, is that when you're an early stage startup, let's say up to a dozen people, maybe 20, then you really can run around being dictator, basically, and making all the decisions. And sometimes you make bad decisions, and sometimes you're a bottleneck. But generally speaking, you can just run around being a dictator. So if you're a good founder, you're probably going to succeed. There's a period then when you're kind of perhaps in the dozen to 50 or dozen to 70 employees, where at that point, you are always the bottleneck and always making bad decisions. There's too many decisions and you're not close enough to what's going on. So at that point, you have to obsess about your direct reports. It's all about the direct reports. Okay. So you try and put a world-class person in each of the specific functional roles. And basically, then it's their job to make the decisions and you're no longer the bottleneck. And all you're doing is kind of like talking with them about how they're making their decisions and just sanity checking and all these things. But in the end, you are no longer a bottleneck or a dependent individual. But beyond that, beyond 50 or perhaps beyond 70, that breaks down as well because they become the dependencies and the bottlenecks. The only way to scale beyond that without the wheels coming off the bus or slowing down is culture. Because culture is what happens when you're not in the room. Yeah. And believe you me, when you've got, as we have at Allica now, 800 people, I'm never in the room. Well, occasionally in the room, right? Culture is what happens in the room. It's the values, the standards, the ways of working, right? And if you obsess about making sure that you bring in the people with the right values, the culture, then you could just about keep going, keep it working. But in the end, it becomes less about people and more about culture. So we obsess about culture. If you're interested in getting a real example of this, Google Allica Bank values. You can go and read our values. They are very distinct from what you'd expect the bank to have as values. Yeah. For example, one of the things we say is no preening. Yeah. We say others worry about job titles and headcount and meetings they attend. We only worry about the outcomes we deliver. We're basically trying to say, if you're that person, do not come here. Yeah. If you're the kind of status obsessed, I'm a managing director, you're not from Allica.
Okay, so like a question around culture, because I mean, a lot of people are talking about culture, but always feel like something not very material. So do you think you could give a couple of examples? I mean, you just gave one, like maybe around people's ego, but how do you create a culture? I mean, for that, I guess part of the response depends on, I mean, ultimately the manager, but then how do you grow it and how do you make sure it remains when you are not in the office, as you said?
So, I mean, first and foremost, you stop the wrong culture getting hired. Yeah. So in other words, you stop it at the front end is the best defense, right? So in a perfect world, you hire everybody you hire has the values you're looking for. Now that becomes really, really hard at a certain scale, but we have nicked one of the many, many things we've nicked from Amazon, by the way, which basically, they're amazing in terms of how they think about stuff. They have what they call bar raisers. So a bar raiser is a specific individual in Amazon who is allowed to do the final interview, and they will never be doing the final interview on someone in their team. They're always from outside the team. Yeah. So if, God forbid, Allica has hired a middle manager, one slipped through the nets, and they're kind of like traditional big bank about status and I don't do work, I manage, and all these things, right? The average middle manager of a bank, they will start hiring people like them. They'll start empire building, B players, hire B players, as they famously say. You're going to start getting a pocket. The other scenario you're going to have is somebody will just get so desperate to fill the role because they're overwhelmed that they'll lower the bar. Yeah, in other words, okay, they'll do. Yeah, you can never have a they'll do. Never. It's unacceptable. A bar raiser is a veto on that. Yeah, they'll meet the person and they're like, Amazon actually say the bar raiser has to make sure they're raising the bar on the existing talent pool. I think that's impossibly hard, by the way. But that's why they call it a bar raiser. But basically, that person doesn't care that you're desperate to fill the hole, and that doesn't care that you're a B player, therefore you can't identify an A player, or you're worried about an A player showing you up. They don't care. They'll just say no, not our standard. So we have bar raisers. I'm a bar raiser. I brought in bar raiser concept. Your interview process is built around our values and trying to sort of evidential. So don't tell me what I want to hear, but show give me examples of where you've done these things and acted in these ways. My interview style, I go very deep into the kind of motivations. I look for that kind of restless ambition and desire to change the world in a good way. And then, of course, your performance management has to be built around the values, and it is, by the way. So you could be the best performing salesperson at Allica, but if you don't meet the bar on leading by example or in it together, which is our collaboration things, then you can't get a high rating, right? And you can't get a good bonus. So a kind of balanced scorecard approach to performance management. There's constant battle, yeah. There's no perfect thing, but what I would say is you have to obsess about culture, yeah. I think one of the founders of HubSpot, I think the less prominent one, the technical founder, once said, your company is going to have a culture anyway, so you might as well make sure it's one you like. Yeah.
Yeah.
It's not like there's no culture if you don't do culture. Yeah, there will be a culture, just be the wrong culture. But I personally, one of the reasons I wrote most of our values, and they're really quite distinctive. I'd actually been at one of the big banks, and there'd been a bit of a Game of Thrones period when they kept firing the CEO, as it was new CEO of the year type stuff. And each one would come in and say, hey, we've got new values, right? And instead of integrity, it was now honesty, right? But the point is basically it just became noise. They just ignored it. And you could very visibly see people who are very senior people without integrity. You're thinking, well, it's just something that we put on the annual report, right? You've got to show you mean it. So we wrote ours differently, and we performance managed it for it. And I'll often be saying to somebody that I really value the team that I can't give you the rating you want because I just don't quite feel this is true of you. So show me I'm wrong. Yeah, show me I'm wrong in the year ahead.
So you mentioned some structure and recruitment techniques to create a culture, maintain it, but you also publicly put on your LinkedIn profile that you essentially use modern management techniques, like the use of OKR, which I think was a methodology born at or massively used at Google, if I'm not mistaken. Do you think you could elaborate on this and how you use that to drive performance? Maybe start by describing what it is, because I don't know, if everybody would be aware of what OKR
so firstly, the technical aspects of OKRs. I mean, they're like slightly more nuanced KPIs, right? Technically, it's not that complicated. So the difference between a KPI approach and or objectives-based approach and OKRs. So OKRs is objectives and key results. So objective is a more generic thing. Key results are the metrics that will make it true. And very often the key results will be more of a balanced scorecard. So for example, I could double our lending book next year, but that would be a very bad idea because the risk is what really matters and getting repaid is what matters in lending. So key results are ways that you will objectively and tangibly measure the objective. So objectives and key results. It's just a slightly more nuanced or thoughtful approach to KPI. But that description is a terrible way of talking about it because it misses the really important point. The really important point is that successful organizations these days, they set objectives for teams and particularly for leaders of those teams. And they give those teams the resources that they need to do what they need to get done. And they trust the teams to get on with it. So it's actually fundamentally, that's the reason that Google has been such a great company, not the fact that you use OKRs. It's the fact that your North Star as a team is this, right? So, if it's, for example, one of our product teams that's focused on our CRM system, it will be raise, speed of resolution of things from X to Y. We raise customer satisfaction with resolution from X to Y. But the point is basically your objective is better customer satisfaction. It might be, or it might be better productivity, whatever it is, but basically, and these are the measurable results. But the most important thing is they are the ones close to the problem. They're the ones living and breathing it. You have a cross-functional team, so you get the software engineers begin to understand the actual problem they're solving, right? They're not coming into somebody else's specifications, just writing some code that's meaningless to them. They're deeply involved in the problem, as are the data people, as are the designers. So it's that empowered teams, empowered towards specific goals and outcomes. That's the important thing. And making sure they're ring fenced. So I talked a few minutes ago about the importance of not slowing down because you get dependencies and bottlenecks. You can have two squads working on different things, and then if there's any dependency between them, for example, that both of them need legal resource, and there's the lawyer team has to decide A or B priority, one of them is going to get slowed down. So you have to, to the fullest extent possible, give them the dedicated resources they need to get their job done. That's how you scale successfully. And the problem is this, right? There's certain phrases, right, that every middle manager and above in any organization knows they should say, right? They should say diversity. They know they should say data-driven, right? They also know they should say empower, yeah? So everybody says this stuff. Very few people do it, yeah? But the problem is everyone's saying it, right? You know, I'm sure I haven't looked. It's not a good job. But I'm sure if I went to one of the big back websites, they'd tell me how they're about diversity and empowerment, and but it doesn't mean it's true. Right? These are buzzwords to be corporates, but you have to mean it.
Do you think you can educate people, or culture is something? I mean, the right culture for you, for example, is it something a person would have or not have, and period, or is it something that grows and you can educate people to essentially change a bit the way they, or it's really
I mean,
part of them?
we have countless examples of people that have come from big banks, and we've had to kind of like just introduce them to freedom. Yeah, I remember there's a fairly talismanic story from the early days where somebody rang up their boss in a panic because they had to change their train ticket because the timing of the meeting they're going to had changed. It would cost £10. So in their previous employer, they did not have the empowerment to actually make it obviously the right decision and spend £10. Yeah, I mean, how crazy is that? Right? If you don't trust a person with £10, why on earth are they working for you? Right? If I don't trust one of my employees with £10, they wouldn't be working for me. So, but this is the nonsense that big organizations come up with, because somebody's status and advancement in the organization comes from the fact that they've got that veto power and that power that everything has to come through them. Right? So it was kind of build this culture of the wrong people rising to the top. I mean, literally, that person was, you don't need to call me about this, right? The irony was, the person they were calling, it was their fault the meeting had changed, right? Why are you calling me about it? Of course you can spend £10, right? There's countless stories of people we've had to sort of, kind of like, we trust you and we empower you. We actually mean it, right? We don't just say it on the job advert, that we actually mean that, right? And it could be quite uncomfortable for people who come from corporate and traditional backgrounds. But if people don't have the underlying values, integrity, actually caring about our customers, and that's not a really generic trite thing. I care about SMEs. I don't care about all types of customers, right? But if I was involved in luxury goods, I really wouldn't care at all. I'd be thinking superficial idiot, right? It's not some generic trite point about customers. I care about SMEs. Yeah, I like business owners. I like them. So caring about the customer, our customers, our types of customers, integrity, doing the right thing, not being political. These are red lines, and people who have those, I don't think you can uneducate those things, right? That passion.
Yes, either you have it or you don't.
Yeah. Unfortunately, some people I think are too far gone, and some people, of course, just don't have the underlying materials to make them the kind of person that we would want. And bluntly, right, not everyone is talented enough for Allica, right? We move quickly, and it's unfortunate, but we have to hold a high bar. We don't want to become like the incumbent.
It's super interesting. I mean, we really can feel that the success of your clients are really at the core of what you do, which is super interesting. I mean, your attention, even the way you go after them in terms of go-to-market. So that's super interesting. We also saw that so Allica Bank acquired like a couple of businesses over the past a year or two. Is it something where they're like, so Toscan Capital and Kria, were there more like opportunistic acquisitions, or is it part of the strategy to acquire maybe 1, 2, 3 businesses a year and grow inorganically?
Yeah, so both of those have a similarity in that they filled in a product gap in both cases actually in lending, but it doesn't have to be lending. So we'd always intended to have a bridging finance provider, which is what Tuscan is, which is it's a shorter term a shorter term property lending is what bridging is. So it's pretty easy to understand. You buy a warehouse, a falling down warehouse in a part of London that's becoming gentrified, and you turn it into a kind of WeWorky type office space. That's why you get bridging finance. It's relatively short-term finance to renovate, to retrofit, and do stuff like that. So and sometimes for transactional. So we were always going to move into that space. It was an obvious accelerator of something we would have done anyway. In fact, I think we'd already started building by that point. It was just like, no, let's accelerate. Good brand, good team, etc., etc. And there's similarities with Korea. We kind of the probably working capital for SMEs. There's literally there's more than 10 different types of products. There's arguably 20 or 30 different types of products. So there was always going to be lots of infilling of what are relatively niche products compared to the overall SME market. It was again an accelerator, and it brought us a position, particularly in embedded finance, which is something that we're very interested in. Yeah, they were. I think opportunistic is probably the wrong word, but fundamentally we would have gone into these areas anyway, and we liked the business and the team, and the timing was right.
Okay, no, makes sense. Can we expect more acquisition in 2026 then, or?
We are a company that we're good at M&A, right? We get to have something that didn't go really well. So, but the thing about M&A, right, is you must be extremely disciplined. However much you want to do something, enter a new thing, the target or the price is not right, you mustn't do it. Yeah. So we will always be looking, we'll always be listening, because we get approached a lot. The reality is you must hold that discipline of however much you superficially want to do it. You can't fall in love with an office, because in the end you have to have the discipline of saying no if the price or target is wrong.
Okay, understood. In terms of branding, so I mean, it's a bit of a mix. So I mean, we spoke about go-to-market, etc. I mean, Allica Bank has definitely like a different type of brand. So when we look at high street banks, I mean, they tend to be the same, like boring, blue, grayish, etc. Allica Bank, you are, something much different. So how did you essentially decided to take that sort of leap of, I don't know if it's of faith, but like that essentially position to be materially different from the others, like in a regulated industry where people might think, okay, you need to give the feeling that you fit in, otherwise it's risky. And based on that, to maybe founders operating in similar types of industry, what would be your advice in terms of branding and make your space and if you could elaborate on this, that would be great.
Firstly, brand is very hard for incumbents, particularly in banking, because I touched on earlier how they're universal banks. They literally serve all the way from a poor student to the largest corporations in the world, like something like HSBC. That's precisely what they'll be doing. Everything, right? So it's very hard to come up with a distinctive cut-through brand when you're talking to so many different things. So you naturally come up with generic and boring, because that's the compromise option, right? And I think, by the way, I think that is the right conclusion to reach if you're such an institution. I don't think it's a bad decision, but that's point number one. And point number two is that you have a very large customer base. You typically have 20% market share of one of those big banks. Therefore, you have to play defense over offense, right? And offense can be a brand that not everyone likes, right? So what if you offend, 50% of your existing customers? That's not a great brand, is it? Brand rebrand. So just to be clear, I think the big banks are very capable at brand, but they have constraints that a challenger does not have. The other side of that is a challenger, and I learned this the hard way at Funding Options. A challenger must be bold to cut through. I said to our board in the early days, I said, we will lose if 80% of our target customers like us. We'll win if 20% of our target customers love us. Yeah. And I do get that played back to me. It clearly landed, right? They're kind of like, I'm going to come to you with sometimes the stuff that's going to be uncomfortable, but that's how we think about this stuff, right? It must be true, because you're only going to move to a challenger if it's 10x, yeah, on a multiple dimension, yeah. So our brand icon is an orange bowler hat, which is very recognizable. So let me just briefly explain brand icon.
See it in the background as well.
There we go. There you go.
I think there's one in the background.
Yeah, there's one of my shirts. So yeah, always be selling. So a brand icon. So for those people in Britain, there's a very good example in financial services, which is an insurance firm called Direct Line. They've been around a long time now, but there was a time they were the challenger. Yeah. And their brand icon is a red telephone box on wheels. And literally every advert would have this little red telephone box with a beepy noise. And basically, the point is, Direct Line is a very boring brand. You won't remember the name of Direct Line. You always remember the red telephone. Yeah. So think about it in these terms. You've seen the adverts. It's all kind of noise, but the red telephone beeps on wheels. It's in your brain, right? You're then actually searching around. You're on a comparison site and you're scrolling down. Never heard of them. Never heard of them. Oh, it's the red telephone guys. Click. Yeah. So it's £10 more than the one before, but at least I've heard of these guys. And then you're at a conference and someone has a business card and it's got the red oh, it's you guys, right? That's the power of a brand icon. Brand icon. Now, it was a leap of faith, as you said, but you must find ways to make, even if you're taking a leap of faith, you must find ways to do a measured test. We initially launched the orange bowler hat as a TV campaign. Yeah, the logo did not change. It was a campaign because we wanted to see the response to the orange bowler hat, whether it had the brand icon saliency I was looking for, and whether it had any consequences. And we talked about it as a campaign. Then about a year later, I mean, it landed so well, right? So it was up there with the red telephone, as you're kind of alluding to. But only a year later, I turned around to my head of marketing. So I'm a camp executive for marketing. We looked at each other and said, we're going to go all in the hat, aren't we? And that was the moment at which that's going to become our logo. Yeah. But the point is basically, we did find a way to test the big bet.
Mm-hmm.
Sometimes you can't test, right? What Amazon calls a one-way door. You step through the door, there's no way back. Most things are two-way doors. The campaign had landed badly. You could have quietly pulled the campaign and done another campaign. Yeah. And so we found a way to test what became our brand icon, and now we're really doubling down on it. And it's that kind of concept of that. Oh, it's the orange bowler hat guys. I'm not making this up. The majority of people I speak to, I've not spoken before, call us Allica Bank, right? There'll be a time that people will know our name as well, but until then, the brand icon does the heavy lifting. That's the vision behind it. And I just want to sort of touch on the kind of boldness point. So challengers have to be bold, right? And I learned that the hard way with funding options. And in fact, I had a brand agency sit down with me, and I chose them because I've never had this before in a marketing agency of any sort. They told me the truth, right? I was like, my God, right? The guy said, look, Conrad, London's a branding capital of the world, best brand agencies in the world. Only New York's even close. There's 100 brand agencies as good as we are. He said, yeah, in my experience, whether this is going to succeed or fail will come down to one thing, whether you're bold enough and brave enough. Yeah. And I wasn't bold enough and brave enough, but he taught me into being bold. And we rebranded funding options and it did cut through, right? I just remember getting loads of trickle through from my LinkedIn. So I love it. You know, people I hadn't heard from years. And that's what happened with the Orange Bowl hat as well, when we launched it. So I learned it's about being bold and brave, right? But fundamentally, empirically, this is proven. This isn't about a leap of faith. There's tons and tons of studies that show two things. Yeah. Firstly, B2B buyers, they buy on emotion and they justify on fact. Yeah. And almost every B2B website has basically kind of like just tons of, bullshit words like synergize and, empower and all this nonsense, right? They talk in corporate language and they just list their features and and they have tables saying, we're better than those guys. Yeah. Tick, 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 cross, cross, cross. Yeah. It's just about the facts. Yeah. But business buyers buy on emotion and they justify on fact. So what is the emotion? Empirically, the most important of all the many things that might be associated with your brand, B2B, is likability. In other words, the one that has the highest correlation with outcome success is likability. And so ours is memorable, but it's also likable. So, although it's a leap of faith, it's a leap of faith deeply embedded in science.
Yeah, it's that makes a lot of sense. Thanks a lot for taking us through that. And then just moving on to some, I guess, maybe wider points of advice as we're coming towards the end of the session today, which has been super fun and really, really insightful. Would you say, so if, for example, your children came to you for career advice today, which kind of environment would you tell them to start in and why? So I know you've been at big corporates like Barclays. You've also been at early stage startups and now the hypergrowth scale up. So What environment would you suggest starting in? And then what environment would you maybe move on to later?
I mean, first and foremost, it's a real question for me. So I've got my older one is starting university this year. So I am very much at that stage. It's not a hypothetical
Find
question.
a corporate job. Find a corporate job, secure.
Look, I mean, it's a very different game to when I came out of university. Globalization has massively raised the bar on talent. Yeah. So, I mean, look, I think not enough people talk about this stuff. I think because it's an uncomfortable topic. But I'm just going to say it. Like, my dad, stumbled out. In fact, he couldn't afford to go to university because he had a very poor background. Qualified as an accountant, and then was sent across to the Caribbean and was put in charge of, I think, 50 or so local people. It's kind of effectively first real job after qualifying as an accountant. That simply wouldn't happen anymore because there's amazing talent around the world, right? And in fact, the accountancy bodies that we produce, specifically the accountancy bodies that we produce in the UK, they are the global accountancy bodies, right? Guess what people in each of these countries are studying, and just as capable as anyone coming out from the UK, probably more so, right? They probably have to work harder because they come from less advantaged backgrounds. My generation was kind of a midpoint from where we are now. London financial services was very, very preeminent, and the kind of the Wimbledon of financial services. These days, not least because our university is turning out lots of extraordinary international students, not just British students. And that wasn't really the case when I was at university, like 30 years ago. It's just a lot harder. Yeah. And even if you ignore the dread topic of AI, which I will get onto, which I can tell you're pointing me towards, but just people need to talk about that fact. Yeah. Globalization has made it a lot tougher. Like the bar is a lot higher than it used to be. Yeah. I wouldn't have been able to stumble out of university, spend 5 years traveling around the world, and then just turn off an investment bank and say, "Hey, hire me," right? Unless there was, some crazy bubble going on, as there sometimes is. That's just a hard fact, and I think there's an element of political correctness where people don't want to talk about these things, but these things are true. But then there's AI. Now, what is extremely clear is that entry-level corporate jobs, white-collar jobs, are dropping off the cliff at this point in time. Yeah, it's scary, right? Now, there's two theses. One is that there's a wait and see. So in other words, let's just tone things down while we see the impact of AI. The other thesis is that these entry-level jobs won't exist anymore in the future. I don't claim to have the answer, but it's pretty terrifying. So if you're coming out and looking for those kind of like higher income professional jobs that were kind of like 2 a penny for a British graduate when I was coming out. I don't really have the answer. But if I could get onto a graduate scheme of a large corporate, to the extent those things still exist, that's what I'd do. Yeah. I'm not, just because I'm an entrepreneur doesn't mean I think it's a great idea to, hey, don't get a real job, go found a company, right? I actually would go and get somebody get paid a decent amount of money for someone to train you how not to do things. Yeah. And then go and found a company. So my big fear is that the corporate graduate schemes are falling off the cliff and might stay that way. I desperately hope that's not the case. They are falling off the cliff. The question is, do they stay that way?
On that point, so I'm sure financing so many like SMEs in the UK, I mean, you must see, essentially the state of the economy fairly well. Regarding AI and like graduate recruitment, etc. Well, I don't know exactly, but I was wondering, is it really because of AI, or is it because essentially the European economy in general is not going that well? So companies are not hiring a lot, particularly, after COVID when they overhired. So now we are in a phase where overhiring plus economic environment, which is not great, essentially we stop hiring. And instead of saying, look, the business is not going so well, we are going to say it's because of AI replacing jobs, and it sounds better. Just another type of idea.
So the kind of macroeconomic points, I don't think that's the case in the UK, because one of the kind of there's no doubt that goods exporting from the UK has come down significantly after Brexit, because the EU was our biggest export market. That's not a political comment, right? It may well be the case that we fill that with higher growth economies in the future, but it is where we are now, a few years on. But services have not been the case. And I understand that service exports have grown significantly. And we are, rightly or wrongly, a service-based economy here in the UK. So those banking and professional services that we do so well in this country, financial and professional services that we do so well in this country are in a decent state. So I personally think it's not macroeconomic. Certainly the lack of the graduate entry jobs, I don't think is macroeconomic. On the wider economy, I mean, we are at the cold face of the SME population, clearly. I would say above all else, it's lack of confidence and stability is what's kind of driven the dampened investment demand in the SME population. So, and that's not a recent thing, right? There's been wave after wave. So we had Brexit, we had the political disruption after Brexit when we kept having new prime ministers saying different things, and then we had COVID, and then we had the highest rise in inflation in decades, fastest rise in interest rate in decades. There's just been wave after wave of things that will make you think, shall I really buy another truck or expand into another premises, right? I think there's lots of demands for investment demand that's just being held back. But people need to have that, business owners need to have that confidence that it's, because if you make an investment decision like expanding into a second premises, you're making a multi-year commitment. So you want that kind of relative confidence of stability. You can't predict the pandemic, most of the things you can sort of see. So I think it's just stability drives investment, and that's dampened because businesses have acted rationally and thought, you know what, I'm going to wait and see a year because I don't have to make this investment now. I think that's what's needed in the SME population, is stability and confidence about that things are stable the next few years. The SMEs have turned out to be extremely resilient, by the way, because very few of the established ones have died during that wave after wave of disruption and instability. That's the good news, right? They're still standing. So I actually have high confidence. They have high cash balances by historic standards, just as UK consumers do. So I think there's a bit of a fortress building up and hopefully some pent-up demand. But I think corporate professional financial services in the UK is still doing well. We are very good at that.
Okay.
And we're lucky. We
sure.
speak English. Geographically, it's a very good location. People are happy to live in London. You know, if you're a Spanish person, you marry a Greek person, the one thing you can agree on is London, right? So there's many reasons that this country is very well positioned for that.
I mean, look at me. I'm French, married to an Italian woman living in London.
There you go. I'm surprised you didn't have to give in, but there you go.
Not yet. Maybe last questions. For last question, so you've seen the fintech world for a long time. If you were to start maybe a new entrepreneurial project, what would it be? Are there any sort of pockets that remain untapped in the broad fintech world? It could be starting something from scratch, or maybe you identified like pockets where you have like a lot of fragmentation and some sort of consolidation play with some technology on top would make a lot of sense. I mean, I don't know if you've thought about this.
Absolutely.
Or if you have any tips.
I still have a midlife crisis, right? Absolutely I do. You know, you're used to the way, there's still some pockets. Oh my God, you're so missing the point. No offense. We are just entering the big wave fintech. Yeah. And so I see this as wave 3, and this one is an order of magnitude more consequential than any of the two before. So this isn't all about pockets. Yeah. This is it. So wave 1, I call lipstick on a pig. So this is when you had some amazing design and product-led people built amazing new types of user interfaces and apps. Monzo is a really good example, just completely reinvented how banking works from a UX perspective. Yeah, suddenly it becomes useful and intuitive and where you need it, right? Brilliant product. But in the end, the infrastructure that's built on is the same rotten infrastructure that everyone else works on, because the payment systems and the networks and all of those things are basically shared infrastructure, okay? That's wave 1, lipstick on a pig, yeah? The lipstick is amazing interface, the pig is the infrastructure. Wave 2 was when those data sources and those infrastructure began to get opened up via API. So funding options within SciFounder was a classic example of that. Open banking, for example, began to give you some amazing capabilities to do better comparison. So opening up data sources, opening up APIs to these things, putting a headless layer on it, basically opened up all kinds of opportunities for commoditization, for aggregation, et cetera, okay? So that's wave 2, but it's still on the same rotten infrastructure. We're just entering the wave when the infrastructure itself gets rebuilt, and it is, in my view, an order of magnitude more consequential than the first 2 individually. So Why is that? It's because stable coins, I guess, is the kind of the fashionable term that kind of brings together what's quite a wide range of different things. But fundamentally, ignore the stable coins bit, because all that stable coins did is basically peg the value of a given crypto to a real world asset so that you couldn't speculate on it. Yeah? You can't speculate on a stable coin. It's always going to be worth $1 or whatever it is, right? Yeah. So they took away the speculation so that you then get focused exclusively on real world functionality. And so stablecoins is only relevant because it's exposed the real world functionality of DeFi. Okay. So in other words, it stopped people doing the let's chase it to the moon type stuff. You can't as a stablecoin. Yeah? It's the smart contract capability that's transformational for financial services. So in the city, right, where I've spent a lot of my career, there are literally hundreds of thousands of very highly paid smart people basically reconciling stuff. Yeah. Because contract documents are PDFs and everyone disagrees on certain terms, and because payments take days to settle. So basically you're kind of like, well, is the money in transit? I've already sent it, blah, blah, blah. Reconciliation. With DeFi capabilities, everything is 24/7, immutable and instantaneous. And so smart contracts functionality is crucial here. It's kind of like when these two things are true, contract will close, right? There's no people involved. There's no reconciliation. Everything is transparent. I think we're beginning the rebuild of the infrastructure now, the infrastructure layer of financial services, and I think it will. This is the bit that takes down the big players. Those that don't stay on top of this is when they go down. It was never going to be wave 1 or 2 of fintech. That was always kind of like quit at the fringe. This is the one where you really have to be good as a big player because you can get
super interesting. No, super interesting. Conrad, thank you so much for your time. I mean, we've learned a lot. I learned a lot, personally speaking. So we'll change a bit of our marketing strategy, etc. We'll add a little hat on our logo too. But really, thank you
so much if you do that.
But thank you so much, Marcus. It was a pleasure as usual. And thank you again.
Thanks, Conrad.